Hello everyone and welcome to This Week in the Markets. So this week we're going to discuss the US equities and the Japanese currency and equity markets. In particular, we're going to be discussing the news that pushed prices higher last week and our outlook for these markets in the near term. But firstly, I'll just share with you our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So equities had quite a big surge on Monday, partly thanks to the better than expected existing home sales data and positive sentiments amongst home builders. Most of the buying, however, was based on the fact that fiscal cliff discussion over the weekend sounded promising, which raised speculation that Congress will actually come up with a compromise before the end of the year. It is always our belief that some compromise would be reached, and that it is very unlikely for the Congress to just let the US economy go over the fiscal cliff. Saying that, we do recognize the differences between the divided Congress and the difficulty in coming up with a compromise during the lame duck session of Congress, which is the period after the election before the terms of the new Congress begins. So it does seem the more likely scenario is for Congress to just put in some temporary amendments and delay the discussion until some time into the future. From a charting perspective, in one way it is quite positive to see the S&P 500 come back above the 200-day moving average instead of pulling further away down from it. However, trading volumes in the last 3 days have been exceptionally low, and this is usually not very assuring for a trend reversal pattern. So until we see more evidence that the S&P 500 is holding above its 200-day moving average, preferably with a rally above the 1400 level, we can only say that equities are still within its bearish short-term trend for now. However, there is a silver lining to this. Consider the AAI Sentiment Survey Index released last week. It shows that the bearish sentiment surged to its highest level since August 2011, when the European debt crisis was at its peak, and the whole euro was basically at the brink of collapse. Debatable, but we don't think we are anywhere near the same situation as we were back then. Secondly, it doesn't seem like the financial market is really agreeing with this bearish outlook from investors either. So if we consider the Bloomberg Financial Condition Index, which as the name suggests combines the various indexes that are useful in describing the current financial condition into a single index. This includes indexes such as swap spreads and implied volatility, which in a way could be thought of as insurance hedge against disastrous events. So according to this index, the internal of the financial market is not suggesting that there is any problem on the horizon either, and doesn't seem to be paying as much attention to the fiscal cliff as the media would have led us to believe. Another area of the market that moved quite a lot last week was the dollar-yen and the Japanese equity markets. Both were influenced by a speech from the former Prime Minister Shinzo Abe of the Liberal Democratic Party, saying that if his party wins the election, he will press the Bank of Japan to set an inflation target of 2 to 3%, which is above the current target rate of 1%, and also with a commitment of unlimited monetary easing and zero to negative interest rates. According to the latest polls, the Liberal Democratic Party is expected to win the coming election in Japan, which falls on the 16th of December, so it is no wonder that the former Prime Minister received so much attention in his speech. We think that if the Liberal Democratic Party does win the next election and the former Prime Minister lives up to his pledge to push the Bank of Japan to implement unlimited monetary easing, we could see the dollar-yen breaking out of its prolonged bottoming process. And given that the Nikkei is so inversely correlated to the Japanese yen, Japanese equities will probably also set up for a new high in this scenario. In the short term, however, there are still too much uncertainties regarding this, and the market reaction in the past week might have been overdone in the Japanese equities and the dollar-yen. And it is also generally very characteristics for the dollar-yen to pull back after a strong surge. So we will not be surprised to see the currency consolidating again or pull back before the December election. And that's all from us this week. There'll be another update video from us next week. And until then, on behalf of the Trading Pursuit team, we wish you all profitable trading.